Paying tax is part of life in Australia, but with smart planning and an understanding of the rules, you can legally reduce how much you owe. The Australian tax system rewards organization, good record keeping, and strategic use of deductions, superannuation, and investment timing. This guide explains practical and lawful ways Australians can save on tax in 2025, from claiming work-related expenses and boosting super to managing investments and using available offsets. Whether you're an employee, investor, or small business owner, knowing where you can save helps you keep more of your hard-earned money while staying fully compliant with the ATO. In 2025, Australians can save on tax by claiming legitimate deductions, contributing to superannuation, managing investment timing, and making use of available offsets and rebates. Careful planning before 30th of June, such as prepaying expenses, deferring income, and maximizing super contributions, can make a big difference. The key is to stay organized, follow ATO rules, and seek advice when needed to ensure all strategies are both effective and legal. How to Save on Taxes in Australia, 2025 edition. Comprehensive, legal, and practical guide for Australian taxpayers. 1. Understanding the Australian tax system. 1.1 2025 Income Tax Rates, Stage 3 Tax Cuts. From 1st July 2024, the federal government's Stage 3 tax cuts changed the marginal tax brackets. Taxable income, tax rate, under $18,200, 0%. $18,201 to $45,000. $45,000 to $135,000, 30%. $135,000, $190,000, 37%. $190,001 and above, 45%. You'll also generally pay the Medicare levy 2% and possibly the Medicare levy surcharge if you earn above the threshold and don't have private hospital cover. Tip: even with the cuts, planning your deductions and super contributions still makes a big difference to how much tax you legally pay. Number 2, know what counts as income. You must declare salary, wages, bonuses and allowances, business and freelance income, rent from property, investment returns, interest, dividends, managed funds, capital gains from selling assets, foreign income if you're an Australian resident for tax purposes. Non-taxable income includes some government benefits, scholarships, and gifts, but always check ATO guidance. Number 3, deductions versus offsets. Deductions reduce your taxable income, e.g. work expenses, donations. Tax offsets reduce your tax payable, e.g. low-income offset, senior and pensioner offset. You can use both together to legally minimize what you owe. Common ways to legally save on tax. 4.1 Work-related expenses. You can claim a deduction for costs that are directly related to earning your income and that your employer didn't reimburse. Examples: work uniforms, protective clothing, tools, and equipment. Union or professional association fees. Work-related travel, not commuting. Subscriptions, licenses, or registrations. Self-education related to your current employment. Working from home. You can use the fixed rate method, 70C per hour, or claim actual costs, electricity, internet, depreciation of office furniture, etc. Keep timesheets and receipts. The ATO requires good record keeping. 4.2 Prepay expenses and defer income. If your income is stable or you expect to earn less next year, you can bring forward deductible expenses into the current year, like insurance or subscriptions. If you expect to earn more next year, you might defer income to avoid pushing yourself into a higher bracket this year. Example: prepay 12 months of income protection insurance before 30 June 2025 to claim it this financial year. 4.3 Boost your superannuation. Super is one of the most powerful tax-saving tools in Australia. Concessional contributions before tax, up to $27,500 per year, taxed at 15% in the fund instead of your marginal rate. Includes employer super and salary sacrifice. Carry forward rule. If your super balance is under $500,000, you can use unused concessional cap amounts from the previous 5 years. Non-concessional contributions. After tax. Help grow your retirement savings, and investment earnings inside super are taxed at only 15%. Tip: salary sacrificing to super can easily save hundreds or thousands in tax each year. 4.4 Investment tax strategies. Capital gains timing. Hold an investment for at least 12 months to qualify for the 50% CGT discount. Offset losses. If you've sold one investment at a profit, consider selling another that's made a loss before 30th of June to offset it. Dividend imputation. Franked dividends come with tax credits for company tax already paid, often resulting in refunds for low or middle income investors. Negative gearing. Property investors can offset rental losses against salary income. Just ensure the property's long-term returns justify the short-term cash loss. 4.5. Use offsets and rebates. Don't miss these. Low income tax offset, LIDO. Low and middle income tax offset, if reintroduced in future budgets. Senior Australians and pensioners offset, franking credit refunds. For retirees and low income investors, charitable donations to registered deductible gift recipients, DGRs. 4.6. Small business and side income deductions. If you're self-employed or run a side hustle, you can claim expenses like marketing, insurance, software, or equipment. The instant asset write-off, currently capped at $20,000 for small businesses, allows immediate deduction for eligible purchases. Split income with family members in legitimate structures, e.g. partnerships or trusts. Always keep invoices, logbooks, and bank records for at least 5 years. Number 5. Advanced tax saving strategies for higher income earners. 5.1. Income structure. Consider setting up a family trust or company to distribute income to lower tax family members. Cap profits at the company tax rate 25 to 30% instead of 37 to 45%. Provide asset protection. These must be genuine commercial arrangements, not sham setups. Get professional advice. 5.2. Superannuation optimization. Maximize concessional contributions each year. Use carry forward tax. Consider transition to retirement TTR strategies from age 60. Keep an eye on Division 293 tax if your income plus concessional contributions exceed the high income threshold of $250,000. 5.3. Capital gains and timing. You can legally manage when to sell assets. Spread asset disposals over multiple years to stay in a lower bracket. Use capital losses to offset gains. Delay or advance sales depending on expected income next year. 5.4. Borrowing to invest. Gearing can create deductions for interest expenses on investment loans. However, if your investment loses value, your deductions may not offset the losses. Only use gearing as part of a long-term wealth strategy, not just for tax benefits. Number 6. Tax-effective super and retirement planning. 6.1. In the accumulation phase, earnings are taxed at 15%. Capital gains on assets held for more than 12 months are effectively taxed at 10%. 6.2. In the pension phase, once you're over 60 and draw from a retirement account, withdrawals are tax-free. Earnings on assets supporting the pension are tax-free up to the transfer balance cap. 6.3. Estate planning. If your super passes to adult children, it can attract death benefit tax. You may consider a recontribution strategy with advice to reduce taxable components. 7. Property investment and rental deductions. You can claim loan interest and bank fees, council rates, insurance, property management fees, repairs, not improvements, depreciation on fittings and fixtures, use of qualified quantity surveyor, travel to inspect property in limited circumstances for commercial property. Note the ATO watches property deductions closely. Ensure expenses are genuine and substantiated. 8. 2025 tax updates and what to watch. Stage 3 tax cuts now in effect. Small business instant asset write-off remains at $20,000. Check budget updates. Super caps may increase with indexation from 1st of July 2025. ATO focus areas for 2025. Work from home claims, rental property deductions, cryptocurrency trading and capital gains. Common mistakes to avoid. Claiming private expenses as work-related. Failing to keep receipts or records. Forgetting to declare all income sources. ATO data matching is very advanced. Joining tax avoidance schemes. The ATO heavily penalizes sham arrangements. Over-gearing, borrowing too much just to get deductions. Year-end tax planning checklist. Estimate your taxable income for the year. Prepay eligible deductible expenses before 30th of June. Maximize super contributions. Check your cap. Gather receipts for work expenses. Review investments for CGT timing. Consider charitable donations. Review insurance cover and private health policy. Lodge through MyTax or with a registered tax agent. Number 11. Finally, saving tax in Australia isn't about dodging the system. It's about using the system smartly and legally. When you plan ahead, claim legitimate deductions, contribute to super, and stay compliant, you can keep more of your income and build long-term wealth. A few $100s in professional accounting advice often saves thousands in tax and gives you peace of mind that you're on the right side of the ATO.